Risk profile is calm, standard deviation of 11.69, the least volatile fund on this list. With only about 32% of the portfolio concentrated in its top 10 holdings, single company blowups don't hurt much. The catch? VIG plays it safe to a fault. The yield is low, the growth is measured, and for investors who need their portfolio to generate real spendable income, VIG's conservatism becomes a ceiling. ETF number 3, VOE, Vanguard Mid-Cap Value ETF. Ticker, VOE. VOE occupies the middle ground. It's not aggressive, but it's not sleepy either. It targets mid-cap companies that appear undervalued relative to their fundamentals. Businesses trading below what their earnings and assets suggest they're worth. The pitch is built-in downside protection combined with meaningful upside potential. 1-year return, 5.62%. 5 years, 67.15%. 10 years, 86.18%. Consistent but not leading the pack. The dividend rate is $3.72, paid quarterly. Expense ratio, 0.07%, impressively cheap. Total assets under management, $30.57 billion. Sector breakdown leans heavily into financials, 17%, industrials, 13%, utilities, 12%, consumer staples and technology, with a real estate allocation as well. It's diversified across economically sensitive and defensive sectors alike. From a risk standpoint, the standard deviation is 14.43, a bit above average. The turnover rate is 19%, and the 1-year tracking error is 9.37%. VOE is a fine fund, but fine is also its ceiling. It doesn't lead in any category, not income, not growth, not stability. It's the kind of fund you hold because it's not bad rather than because it's exceptional. ETF number 4, DVY, iShares Select Dividend ETF. Ticker, DVY. DVY isn't trying to grow your wealth, it's trying to pay you. This is the income specialist of the group, designed for investors who want consistent cash flow, not capital appreciation. Retirees and near retirees tend to gravitate here. Returns reflect that priority. 1 year, up 5.11%. 5 years, 62.67%. 10 years, 80.14%. Not impressive growth numbers, but again, that's not the mission. What DVY does deliver is income. The trailing 12-month dividend rate is $5.15 per share, paid quarterly. Expense ratio, 0.38%, higher than the others, but still reasonable given the fund's specialized focus. Total assets, nearly $20 billion. DVY holds about 107 U.S. companies, and more than half the portfolio sits in just 2 sectors, financials and utilities. Consumer staples, energy, and communication services fill out the rest. Tech barely registers at 4.5%, and that's intentional. This fund avoids volatility and sticks with predictable income producers. Think Ford, Altria, Pfizer. The standard deviation is 15.38, the highest on this list. It moves around more than you'd expect from an income fund, though the 19% turnover rate means it's not aggressively trading. It buys and holds, just like the investors who own it. If steady cash flow is the entire goal, DVY delivers, but you're trading away diversification, growth potential, and long-term wealth building to get it. ETF number 5, SCHD, Schwab U.S. Dividend Equity ETF. Ticker, SCHD. Here's where the conversation shifts. SCHD has built a loyal following among serious dividend investors, and when you look at what the fund actually does, it's not hard to understand why. It doesn't ask you to choose between income and growth, it gives you both. The past year has been a rough patch. SCHD dipped about 1.09%, but one difficult year doesn't tell you much about a fund built for decades. Zoom out and the picture changes entirely. Up 52.61% over 5 years, 113.93% over 10. That's where SCHD builds serious wealth through patient, compounding growth over time. What really separates SCHD is how selective it is. To earn a spot in this fund, a company has to clear a high bar, at least 10 consecutive years of dividend payments, demonstrated profitability, a strong balance sheet, and a genuine track record of rewarding shareholders. That screen cuts out the flaky stuff and keeps the quality high.